Hi, Daniel. Welcome back to Face.
All right, can you hear me?
Got you, buddy.
Loud and clear.
Awesome.
You want to share your screen now?
Yeah, I will. Give me a second here while I get it
Okay.
finalized.
All righty. I've known Daniel for many years, going all the way back to FX Street, and very good technician, real clean charts, no BS on Daniel's charts. You see those lines, and they mean something. So you told me you're going to be talking about grains. I think that's going to be interesting with, the fact that they're coming out of multi-year bases and starting to perform.
Yeah, they absolutely are here. All right, let's see.
What asset class did you talk about, Dale?
Grains.
Grains. Okay.
Yeah, I mean, beans led it, and then
Yeah, my
corn and wheat.
prediction is all of those assets are going to explode denominated in dollars.
Yeah.
Yeah, I
So
completely agree, and that was one of the topics I talked with Dale originally about was how, let's see, can you guys see that
We
screen
got
share
it.
there?
Yes,
We've got a
corn.
corn chart up, I think.
yeah,
Great. Before we even hop into corn and into the charts, though, I figured, Dale, like you said, we've known each other for some time now, back to the days when you were with FX Street, and I was with Elliott Wave Forecast back then. Wow, how our careers have changed. And, I began my career on the floor of the Mercantile Exchange, actually in the Eurodollar options pits, but made my way into grains. I thought it would be interesting to give a little bit of my backstory here because I think it resonates with a lot of the traders out there. Many of us began or started our careers looking at FX. It's the most easily accessible markets out there. They give you the highest leverage and you can get the most bang for your buck in trading those markets. But you're a minnow, in the middle of the ocean. And there's this giant whale called a central bank that can come around and decide to change monetary policy overnight and makes trading, while trends, right, and currencies can be great, long lasting. And I really enjoyed some of your commentary, you guys, earlier today. That was great to see that. I think we have a lot of the same ideas of what might be
do you
the
remember
future of the
floor
dollar might
trader
be here.
Daniel? You remember a floor trader? His last name was Bregman.
Mm-hmm.
And he used to take on central banks in the IMM pits, and it's before there was a lot of coordination, and he loved to fade central bank action because he felt that whatever they were doing before central planning really gained momentum was just temporary to support their currencies, and there were all kinds of currency devaluations in the 80s and late 70s, and they used to call them the bank. So, you learned a lot on the floor. When were you on the floor? What years? I know you're a lot younger than me.
Yeah, I caught the tail end from the early 2000s there,
Okay.
through actually my late high school career through college. I was on the floor during the summers, had a brief stint there out of school. And then the financial crisis happened,
Yeah.
and I took the great advice from the broker I worked for. I was an arbitrage clerk. For those that don't know, I was one of the guys with a headset making all the
Yeah.
funny hand signals with some of the banks that were lining the outskirts of the room, coordinating trades, and I would pass those trades to the broker, who then would turn around in the pit and fill those orders for the big banks. They gave me the great advice, Dan, you got to make sure you finish school, get off the floor, go learn how this industry happens behind the screen, because that's the future. And boy, wasn't that the truth.
Yeah, a lot of people couldn't make the transition because they made money off paper. All they
Absolutely.
had to do was, trade the paper, either filling it or scalping off of it. And once that disappeared, it was career ending for a lot of people.
It really
Those
was.
lucky bastards.
Yeah, what a time of an era where you could have a slightly different market on two sides of the pit and give those locals the ability to take it from one side, move it to the other, make their tick in the middle, and fill that paper. And it was a job to be done, and they took on risks to do so. But unfortunately, right, the likes of algorithmic trading and high frequency trading have made that more efficient, you could say, and unfortunately way too quick for the human hand to deal in.
Yeah. So
But,
we're looking at Dixie. Your background, you know, you were fortunate to catch a tail end and be able to rub elbows with guys like that on the floor. Much tougher now for people that have to wade through the internet that want to learn about the markets because there's so much junk out there
and it's
that you
funny, I
really need.
was
Go ahead.
in the shower this morning thinking of talking points, and that was one that came up was, wow, why over the last 5 years did I move away from some social media and really hone in on my training? Because I thought I lost my own voice, and I felt I felt like I was losing touch with good information. There was just so much noise out there on the internet, on Twitter, on Facebook, everywhere you turn, every news media agency out there today. It is all about hysteria, chaos, and keeping that kind of I don't know, keeping that running through society. And it's been that way for, it feels like 10 years now. And with this latest pandemic, it really has come to a boiling point, hasn't it? And I feel that you can get lost in that noise as a trader. And it's very difficult in many markets, which is a big reason I moved to focus and hone in on grains and kind of regrow from there, is because I came from trading currencies, which actually are not that different than grains, which we'll look at here today. Spread markets. If you can trade currencies, you can trade any spread market in the world because every currency is a spread. You already understand the idea of two moving markets, the value of one currency versus the value of the other. And we're always trading them as spreads, right? And FX crosses. And that translates into grains very, very well. The problem we have with FX, or maybe even indices and other markets, the only problem I ever had with them was, how do I hone in on the fundamental side of the trade and really, you know, sink my teeth into what seems to always be a tough trade to get behind, which is trading fundamentals in some of those markets. They oftentimes, right, get faded for a little while. It takes longer for the true longer term fundamental to come through sometimes. And sometimes the technical trade really dictates price action, which I think is why many of us gravitate to technicals, because there's a lot less noise when you look at a chart objectively that way.
All right. Well, so, you're on the Merc, Daniel, and I'm getting a question because I sure remember this pit. Forex Gal is asking, sell or buy lumber, and the lumber pit had quite a reputation, didn't it?
It really did. The gold pit as well. It was an old boys club, if you will, right, that if you were not on the inside there, you were always going to be on the outside and never getting the best service, if you will. I don't know how else to put it. But there were always legendary stories about how, markets that were that tight knit and that closed off, particularly lumber, right? There's only so many lumber producers in the world. There's only so much supply. It's not like gold that where it's being held in every bank and vault in the world. Lumber's got a very niche market, right? And like all commodities, it really, there is an element of supply and demand. However, lumber is a small enough market where single market participants can come in and be the lion's share of volume or participation. That's very hard to do in the E-mini or the bonds. I would actually argue impossible to do.
So would you agree with me when I would tell Forex Gal, find something else to trade?
Absolutely. We live in an era where there are markets with such deep liquidity and such fast execution that there's no sense dabbling in those markets where you can get really stung just by failure of execution. You can be dead right about the trend and lose money because you fail to execute it in an illiquid market with slippage and all of these other things that can go into it.
A lot of limit moves.
Yeah, absolutely. When you wake up the next morning and there have been almost no trades and we're just at a limit move higher, that's a typical day for lumber.
So that was a good question. It's probably going to save you some money, Forex Gal. All right, so Daniel, we're looking at Dixie. I have a bias that formation we saw in August is a 3 drive to a bottom. And, 94 is big, but to me, it looks like we have a bear market rally setting up that could get to your horizontal box and maybe your purple line before it runs out of juice, in my opinion.
Absolutely. And the lines on the chart here, it's a simple 50, 100, and 200-day moving average, everyone. And it's the most simple, right, definition of a trend many technical indicators begin with. The thing I want to point out is we've had that bearish crossover for both the 50, 100, and the 200-day moving averages. That's big on a daily technical time frame. That is an indication, right, that, hey, maybe something is shifting on a longer time frame for the US dollar to the downside. And when you take that step back to a multi-year chart of that Dixie, you see that 104 to 90 to 89 range we've been in. And it feels a lot like the market is in a period of price discovery lower down to the low end of this range in this, kind of leg lower that we're in. I tend to agree with you. I saw a little bit there at the start of the webinar about this 93 to 94 area. Yeah, we've got a congestion zone that we've now broken below. Series of highs, or excuse me, lows as we were coming up in this, very choppy trend higher for the Dixie, are now making for, I think a cluster of resistance on the way down that we're trying to hold below. Those key levels bring us all the way back to the end of 2018, when I think we saw a pretty dynamic shift in the dollar. We saw the trade war with China kind of come to the front and center. We saw exports for the U.S. dive off. And by the way, China started talking with a rhetoric that they would love to do business with the U.S. And I'm really speaking more towards the grain side of things here, because that's where we've been able to get a deal done and move forward with some trade. They were always talking about this rhetoric of when, quote unquote, market conditions allow. And our team at Zaner, myself and another senior broker here, Ted Seifried, we kind of took that as, well, what are the things that, what are the comparative things that China would be looking at in our commodities, that they would need? Because the fact is, China has 1 billion people. They need to keep fed and happy. That's true of any nation, right? But the difference with China is that over the last 20 years, we have seen them, unfortunately, go from a highly agrarian society to now highly urban society, and now do not produce enough agricultural products to feed their own country. So they are now economically dependent on export, or on agricultural imports, particularly for soybeans, pork products. U.S. corn now is on that list as well. These are needed to keep, not only financial but economic and social stability in China, because the worst thing any nation or government could have is a famine where people are not being fed. And Colombia and Argentina of the last decade are a good example of countries where when you run out of food and you can't feed a population, you see civil unrest begins very quickly. All that being said, what did that mean for the dollar?
And Daniel, aren't they having issues with pestilence in the crops, something called an army worm?
Yes.
I'm not sure which which crop it feasts upon. Is
Corn.
it wheat? Corn?
Corn,
Okay.
in fact. It has been decimating, and China has never had a good, China, so everyone is aware, is on the exact same growing season as the United States. So to give everybody the quick rundown of supply and demand economics and grains, it's very simple. There are two main supply times during the year: when the northern hemisphere harvests corn and soybeans, and when the southern hemisphere harvests them. Other than that, we do not produce this commodity at all throughout any other point during the year. So there's only 2 times during the year that we adjust how much we've produced and know what the supply side of the economic balance sheet looks like. Now that demand side, that's all really contingent on China. But China also produces corn and soybeans nationally. They, however, have been very poor at producing a corn crop. They've been very poor at storing a corn crop historically. And you're right, they are plagued by other infestations of insect plagues that we do not get, like this army worm that this year decimated their corn crop. Over the last 3 weeks, we have seen now China talk about maybe upping their corn purchases from the United States. And we've not only heard rumors of going from purchasing around 7 million, around the 7, now I need to look at the actual number, but anyway, they were going to increase it by 4 times. And we've seen exports over the last 4 weeks that have kind of justified that pace of purchasing. And that's the big story, I think, in grains here, is that since August, China has come in and purchased about 50% of what they needed to get not only the phase one trade deal done, but to make good on all of the estimated exports for this year. That's been done in the last 8-week time frame. That's an exorbitant amount of purchasing. And while the dollar has declined, and just to bring this back to finish
That
first
supports
point,
grain prices, the weaker
absolutely.
dollar nominally.
Bingo. Anything dollar denominated, our export markets get hurt. Doesn't matter if it's oil, doesn't matter if it's corn and beans and other agricultural products. When the dollar goes down in value, outside forces, those exporters actually have more purchasing power. And that actually, that idea of soybean prices going higher actually helps China in another way we'll look at later. But the fall in the dollar, we believe, was the exact rhetoric or meeting of the rhetoric that China needed, the quote unquote market conditions to start with these purchases. And if we see, if we go back to 2018 to 2017 and this last big dollar decline, well, that marked the last record for Chinese exports of soy products. Then through 18 through 19, we got into a trade war that brought us into 2020 and sent the dollar to its highest levels in a decade. China ultimately seized up on their purchasing and did nothing. All of a sudden, starting in June of this year, we started to see big purchases start to come out of China. And along that same time frame, you'd think that that would be positive for the US dollar because, right, China's using US dollars to buy US goods. But there's some other forces going on behind the scenes in bond markets, with treasuries, and just the currencies that are keeping the dollar down. And China used this opportunity over the last several months to do major one-off purchases of US agricultural products to make good on both their phase one trade deal and take advantage of the market conditions that are beneficial for the Chinese trader.
They're pretty good technicians too, right, Daniel?
Yes.
So if they see what we see and that the dollar could come back 5% or
absolutely.
so, this is the time to do it with the cheap dollar.
And that's what we're seeing, I think, a lot of today. These rampant exports of agricultural products over the last 4 weeks are a response to this. And that's why, as an ag trader, I'm following currencies every day because these matter. We get a move up to 95, 97 in the DXY. That could slow down China for a bit. And I would know as a grain trader, maybe these markets that have had such a strong run up are also going to see a little bit of a setback. Take the price of November soybeans. We've had a run up from the 808 level. The lowest prices for Novi beans. Actually, let me bring up just the daily chart. We don't need a continuous chart up here for this. There we go. Contract low is at 830 here back in on April 20th. We have rallied over $2 since that April 20th low. And really the August 10th low that marked a major USDA announcement where the USDA came out and basically said that big storm we had in August, plus a lot of the dry weather we had to start the month, the USDA came out and said, yeah, we are not going to make yields where we thought they were. Coupled with Chinese purchasing, you can see the very, very perfect storm that occurred in soybeans for a rally, which was you've got your biggest buyer in the world coming back to the US market and buying hand over fist everything they can get hands on. You had a USDA fundamental report that came out and said, hey, yields are not going to be the best we've ever seen, which is what we were all anticipating at that point. And they reversed and walked back and said that storm and the drought over the last 4 weeks has done enough damage that we have made our crop. So ergo, all the traders, including myself, get the mentality that, okay, we can't do any better on yield. So whatever we've produced is in the field now. It can only go down from here. And thus price rationing began.
That looks like the silver move.
Yes. And it was an explosive move that, was there something here holding prices down for some time? I'd like to, put my tinfoil hat on and say that maybe China was very short soybeans in the US on the board and then decided to get very long soybeans on the board, because if they're going to, continue with future purchases, they can only get their hands on so much physical right now. They've got to go to the board for the rest of the future purchases for the rest of this marketing year. So seeing the run up now to 10, up to levels of near 1040, the real question is how high can this market go? We're in uncharted territory for the November soybean. These are new contract highs. We are well above the highs we were holding below 2018 through 2019, which was this $9.80 to $10 level. And that's right where I would put, our current broken resistance, now support, going into the end of the light, end of the contract and into harvest. If I could get a rectangle to draw for me. There we go. $10 is a key psychological level for soybeans. But we do have now the 50-day moving above the 200-day. The 100-day is starting to move maybe above the 200-day here over the next couple of days or so. So we're getting that golden crossover event as well. This, to me, now when you step back to that larger time frame, look at the continuous chart, look at where we were in 2018, right? Back when the US dollar was at its lowest levels in the last few years. We were up at 1050, 1060 in soybeans. We've traded right back to those levels in soybeans here today. And I am of the camp that I think we're into this $10.50 to $11 range in beans as that US dollar makes its way down towards that low $90 dollar area in the DXY. So you're seeing some correlation here. While the soybeans took some time to really catch up on that trend, they are coming back to the levels where I think there is some correlation between when and how China's participating in a market. We're seeing them buy every day with new flash export sales. Those numbers usually come out right around now. Let's see if they had a new purchase today. They did. It looks like China today just bought 132,000 metric tons of soybeans. That 132,000 metric tons equates to, I'll tell you how many bushels here in 1 second. For those that you follow along, the U.S. counts everything in bushels, while the so that's about 5 million bushels worth of soybeans. The USDA, to put that everybody into perspective, that is 1/20th of what the USDA thinks we will have left over for soybeans at the end of the year, and that's a very substantial thing because, hey, soybeans,
no carryover.
Exactly. We only produce soybeans but once a year in the United States. So at harvest, we'll have all the soybeans we'll have again until next November. If China just bought 5 million bushels worth, and we think we're going to only have 400 million bushels worth at the end of the year anyway, China only has the rest of this month worth of exports. And they've been doing this every day, buying at least 5 million bushels for the last 2 months. If they keep at this pace, we will literally run out of beans before harvest is complete. And that is what the market's starting to realize, and why we're seeing this massive, what is referred to as an inversion, a big run up in the front month prices of soybeans, because people are afraid we won't have them down the road. And when you look,
it's the opposite of backwardation, isn't it?
Correct. It's the opposite of backwardation. And when I'll open I'll change these columns here so we can all see here we go. You can see the November soybean trading at 1039, right? Well, if we go back to July and November of next year, July soybeans of next year at 1029. They're below. You can buy soybeans July of next year cheaper than you can buy them right now.
Right.
And that's not typical in the grains, but the reason being is backwardization, like you just said, Dale. And it's because there's a fear that we won't have them in the future, so you need to get them all right now for whatever.
As opposed to carrying charge market.
Correct, which is where you would be.
Prices would be higher in the deferred months.
Correct, with the idea that you are recouping some of the storage costs to get yourself to that month. Right. And that's what happens in more bearish market conditions. And over the last 5 years, that's what we've seen in soybeans. We've seen conditions where we've produced absolutely impressive record yields. This year's soybean yields themselves, the USDA was originally thinking, this is a chart from agmanager.info. This is the K-State Ag Department. They do a great job. Anyone that wants to pull the very quick economics and get the data on grains, because it is so widely known, this educational institution publishes them all after every major WISE report, so everybody can go and get them. I use them. Everyone I know goes and grabs these because they've done the balance sheet for you. In other words, what does it look like, that supply and demand economic? And you can see how this year we thought that trend yield, which is what we anticipate how much yield increases every year because we get better at growing, we anticipated us being better than trend yield this year. Now that's not looking like the case. Because we're going to be backing off that trend yield, and U.S. exports of soybeans have been just absolutely astronomical. While this continues to grow, those soybean potential or export potential continues to grow, our ending stock continues to diminish. And you can see here, this was as of our last report. We were thinking we'd have about a 10% stock to usage ratio. That means that everyone that we would have 10% left over at the end of the year of what we would need for the following year. In other words, we'd only have 10% of what we needed for the entire year's demand left over. Typically, and this is a good ratio to use in grains because it's very straightforward, and it really only changes but once a year at harvest, because you know how much you produced, how much you have left over, and how much next year's production may or may not be based off a trend yield. You can kind of figure out more or less if prices can be more bearish or bullish. Because we're going into what we refer to as a tightening event, we're seeing supplies really tighten because China's exporting them, they're taking them away. This ending stocks number and the stock to usage ratio is shrinking. And when we dip below this 10% threshold, we start to see, the elasticity of demand really starts to show its head. In other words, we really start to run out of beans and people become fearful. 2012, back in 2012, we had a major drought. That's what sent soybeans up $15 to $18 a bushel. I don't think we'll get that crazy, but you can see how below $10 or this 10% threshold is really, if you go back and you look at any of these years below that threshold, you will see that those are the years where, okay, there's clearly more of a bid under grains. Markets are more well supported because we're fearful that there isn't enough demand or supply to meet that demand. And running out of foodstuffs is one of the more scary things that can happen in commodities, and hence why there is panic buying that can occur. And that's what I think we're starting to see. That's the trend we've been seeing, and it's all really, really been kicked off by the value of the dollar and those market conditions that China needed to see, which is all, in my opinion, completely tied to the value of that US dollar.
What a great presentation, Daniel.
Awesome. Well, I hope everyone enjoyed it. For some upside targets here in the near term.
Beans in the teens, bro.
Yeah, we could. If there was a year and an opportunity to see it happen, it could. Obviously, when you look at this continuation chart, you can see going back to 2016, 2017, there's some congestion zones here, $12, $10.50, $11 to chew through. But if there was ever a year to do it, this could be it.
And the best way for people to follow your work besides Twitter, or including Twitter, Daniel?
Right. You can find me on Twitter at Daniel Hussey Jr. You can also shoot me an email, dhussey@zaner.com. 312-277-0110. Drop me a call if you ever want to talk commodities, risk management, and particularly in the grains. But following me there on Twitter would be the best.
How about, can I call you to talk about the Bears starting 2-0?
Absolutely. And how about Travinsky finding his arm, huh? I'll take it.
You found your voice and he found his arm, and thank you for really edifying our community and talking about, you can't eat gold, can you, Daniel? So
no, you can't. You can't.
And they call beans protein gold.
That's right. That's right.
It's still like buying gold, only it's edible.
And in a year where we might be seeing some higher inflationary type pressures, agricultural markets will benefit from those as well.
Thank you for edifying our community today, my trading warrior brother. Appreciate it.
Absolutely. Have a good one, Dale. Take care. Have a good one, everybody.
All right.
Bye.
Daniel Hussey, follow him at Daniel Hussey on Twitter, and he's with, I believe it's Zaner. It's a commodity. I'm not sure if it's an FCM, IB, but I know the name.
We are an IB, yeah. If I'm still on with it, we are an IB, and it is Zaner Financial Services. But thanks, everybody, and I'll get off here.
All right, I'll get, we'll hook something up for down the road, Daniel. Thank you, buddy. So that's a wrap, everyone, and we'll see everyone for Turnaround Tuesday. Good hunting. Remember to sign up for the summit and our offer. I'll see everyone tomorrow. You're welcome, Skip. There you go. That's where you can reach Daniel. You're welcome, Brock. Thank you, guys. See you tomorrow for Turnaround Tuesday. You're welcome, Sa.